the chart that looks like science, but fails basic statistics. Welcome to the Deep Dive. It is Saturday, April 4th, 2026, and today, you and I are going on a mission.
A pretty massive mission, honestly.
Yeah, totally, because our goal today is to examine this huge stack of empirical research, historical market data, and, advanced statistical corrections that systematically dismantle what is probably the most widely shared, universally believed chart in all of finance.
Right. I mean, it's a chart you see literally everywhere. It's become this foundational pillar of modern investment theory. And yet, well, when you actually pull back the curtain on the math, it is just a masterclass in visual deception.
It really is. But before we get into the weeds, I want to set the stage for you, the listener. If you spend any time on financial social media, or if you follow market analysts on LinkedIn or X,
Or if you read those glossy institutional research decks from the biggest banks in the world, you absolutely know this chart.
exactly. Visually, it's a scatter plot. On the horizontal axis, the x-axis, you have the valuation of the stock market. Specifically, they use the S&P 500 price-to-earnings ratio, and almost always, it is the Shiller-Seal ratio.
Right, which stands for cyclically adjusted price to earnings. We should probably define that quickly just so everyone is on the same page before we tear it apart.
Good idea. Go for it.
So a standard price to earnings ratio just looks at the price of a stock divided by its earnings over the past year. But, earnings can be really volatile. Like in a recession, corporate profits just
Then
collapse.
fall off a cliff.
Yeah, which makes the standard PE ratio suddenly spike, making the market look artificially expensive right at the very bottom of a crash.
Which is incredibly counterintuitive for an investor who is just trying to figure out if stocks are on sale. I mean, you want to buy low, but the basic metric is telling you it's expensive.
Precisely. And that's why Robert Shiller, the Nobel laureate, popularized the KE ratio. Instead of looking at just one single year of earnings, the KPE ratio takes the average of the last 10 years of corporate earnings.
Oh, okay.
And it adjusts all of those years for inflation. The whole idea is to smooth out the business cycle. It gives you this cleaner, more stable picture of whether the market is fundamentally cheap or expensive relative to its long-term baseline.
Okay, so let's unpack this visual. We have our x-axis, which is this 10-year smooth valuation metric.
Right.
Then, on the vertical y-axis of our famous chart, you have the subsequent 10-year annualized return to the stock market.
Right. So if the dot is plotted in, say, the year 1990, the y-axis shows what the stock market actually returned per year all the way out to the year 2000.
Got it. And when you plot all historical data this way, the resulting image is an absolute masterpiece of persuasion. It really is.
It's beautiful. I mean, from a purely aesthetic standpoint, it is incredibly convincing.
Oh, totally. When you look at it, you see this incredibly dense, tight cloud of dots. We were talking about an army of over 1,500 individual data points, and they just slope neatly, almost perfectly, downward from the top left to the bottom right.
Yeah, and that visual creates a deeply intuitive, seductive story that completely aligns with what we all want to believe about the world, right?
Buy cheap, get rich.
Exactly. Buy when the market is cheap, and you are guaranteed to earn massive returns over the next decade. Buy when the market is expensive, and your returns will just be terrible. It looks as irrefutable as gravity.
It looks deterministic, honestly. Like it gives the viewer the illusion that current market valuations pin down future decade-long returns with just astonishing precision.
Yeah, and notice there are no error bars on the versions shared online. None at all.
Nope, none. There are no confidence bands. There's no nuance. You just see this massive swarm of dots and a sharp regression line cutting right through the middle, basically telling you exactly what to expect from your retirement portfolio.
Right, which is why it's so dangerous.
So here is where I am going to plug back. On behalf of everyone listening who has seen this chart and maybe even based their 401k allocations on it and thought it made perfect sense.
Sure, lay it on me.
If I am looking at over 1,000 distinct data points representing over a century of recorded stock market history, and they form a nearly perfect downward line, I mean, why shouldn't I trust my own eyes? How can 1,000 historical facts be wrong?
Well, because the narrative assumes those 1,593 dots represent independent trials. And they do not. They represent an illusion known in statistics as pseudo-replication. It's a fake sample size.
Wait, a fake sample size? What do you mean? The dates on the bottom of the chart are real historical months, aren't they? Like the market actually traded on those dates.
I mean, the dates are real calendar months, yes. The market was absolutely open. But the independent information contained in those dots is not real. This chart has over 1,000 dots. Let me show you how many are actually independent.
Let's do it. Walk me through the actual numbers in the research stack because I'm genuinely curious how bad this is.
So, there's a bar chart in the empirical data that makes this devastatingly clear. It compares two numbers. The first bar represents the 1,593 monthly overlapping observations that you see plotted on the viral social media chart.
Okay, the big giant clap.
Right. And the second bar, sitting right next to it, represents the number of genuinely non-overlapping 10-year episodes available in that exact same historical sample. That number is roughly 14.
Whoa, I need to stop you there. You saying 14? Like 1, 4?
14, yes. The viral chart plots nearly 1,600 dots, but it really only contains about 14 truly independent 10-year windows.
That's insane.
The ratio of plotted observations to actual independent observations is roughly 114 to 1. For every genuinely new piece of information the market provides, this chart is showing you over 100 recycled copies of nearly the exact same data.
Man, my brain is struggling to process how you melt down 1,500 data points into 14. I need an analogy here. Let me try one.
Go for it.
This feels like, imagine there is a car crash at a busy intersection, and a traffic camera on the corner takes 120 rapid-fire photographs of that exact same car crash, just a fraction of a second apart.
Okay, I like where this is going.
So each photo is technically from a millisecond later, right? Maybe the bumper's crunched a millimeter further. And then I take those 120 photos, march into a courtroom, slap them on the judge's desk and say, Your Honor, I have statistically significant evidence of 120 independent car crashes. This intersection is a historic menace.
That is an incredibly accurate analogy. It really is. And think about what the judge would actually say to you.
I'd probably be arrested for perjury or something.
The judge would absolutely throw you out of court for insulting their intelligence. I mean, in any rigorous scientific discipline, ecology, medicine, physics, if you brought those 120 photos to a peer review board and claimed a sample size of 120, your paper would be instantly rejected.
It's immediately tossed in the trash.
Yeah, for pseudo-replication. It is a known, heavily documented statistical pathology.
But in the world of finance, this specific type of pseudo-replication doesn't get you thrown out of court. It gets you thousands of likes on LinkedIn and a feature in a big bank's quarterly outlook.
Yes, because people are just so hungry for certainty and complex systems rarely offer it. Let's trace the mechanics of this recycling, though, because it is crucial to understand exactly how the math is being manipulated behind the scenes.
Okay, yeah. Let's walk through the timeline of how these dots are actually constructed. I'm picturing the timeline in my head.
Okay, so the viral chart plots monthly observations. So every dot on the x-axis is a new month. But remember what the outcome on the axis is actually measuring. It's a 10-year forward return. And a 10-year period contains 120 months.
Right, a full decade of compound interest.
So let's say your very first data point, your first dot on the scatterplot, is January 1990. To calculate the 10-year future return for that specific dot, you track the stock market's performance from January 1990 all the way to January 2000.
That's 120 months of continuous market movement. Makes perfect sense. That gives me the coordinate for my January 1990 dot.
Exactly. Now, your very next dot on the scatterplot is just one single month later, February 1990. To calculate the future return for that dot, you track the market from February 1990 to February 2000.
Oh, wow, I see the trap.
Yeah, it is glaring once you look for it. Those two 10-year windows, the one starting in January and the one starting in February, they share 119 of the exact same months of market history.
Because they're almost entirely overlapping.
Right. The only difference is that the February dot drops the performance of January 1990 and tacks on the performance of January 2000 at the very end. Everything in between, like the entire bull market of the 1990s, the Asian financial crisis in 1997, the start of the dot-com boom, it is perfectly identical in both dots.
So they are, what, 99.2% the same observation?
Exactly, 99.2% the same. So when you trace your finger from one dot to the next on that dense, beautiful scatter plot, you are not looking at a new experiment.
I'm not seeing how the market reacted to a new valuation environment.
No, you are looking at 99.2% of the exact same future decade, just shifted over by 4 short weeks.
And you do that 120 times before you finally clear the data from that first decade. That is wild.
It is. The research data actually includes a heat map showing how many times each calendar year is reused in this chart. Interior years, years sitting right in the middle of the historical sample, like the 1950s or the 1970s, they are reused up to 120 times each.
So the math is literally just double counting, triple counting, and 100 tuple counting The exact same market movements,
Precisely.
which creates that massive visual gravity. I mean, that explains why the cloud of dots looks so tight. It forces all those dots to cluster together because they are literally chained to one another by the overlap. They're basically genetic clones.
Clones with a 0.8% mutation rate, yeah. And the statistical fallout from this massive recycling is catastrophic if you try to use basic, naive math to measure the relationship. Let's talk about residual autocorrelation.
Okay, residual autocorrelation. Break that down for me like I am a beginner, because that sounds like something you need a PhD to care about, but it seems to be the murder weapon here.
I can do that. So when you draw a regression line through a scatter plot, that straight line trying to capture the trend, you use a technique called ordinary least squares, or OLS.
Okay, OLS.
Now, OLS is a fantastic mathematical tool, but it comes with a strict set of assumptions. The biggest assumption is that every single data point is a brand new, completely independent piece of information, like flipping a coin.
Right. If I flip a coin and get heads, the universe doesn't remember that. The next flip is completely independent. The odds completely reset.
Exactly. OLS expects your data to act like coin flips. When the computer runs OLS on this viral chart, it assumes it is looking at 1,593 completely independent 10-year periods of stock market history.
Wait, 1,593 independent decades, which would mean we have roughly 16,000 years of recorded stock market data. We'd literally have to be plotting PE ratios from ancient Mesopotamia.
Yeah, the Babylonian Stock Exchange. We obviously don't have that. We have about 140 years of good data. But because the computer thinks it has 16,000 years of evidence, it becomes incredibly overconfident in the trend line.
Overconfident computers are dangerous.
Very. The residuals, which is just the distance between each dot and the trend line, are massively autocorrelated. That means the error on one dot is almost exactly the same as the error on the next dot because, well, they are the same data.
So the computer thinks it has found a universal law of nature, purely because we fed it the same 14 decades on a loop and tricked it. It is the fake X-ray. It gives us an illusion of precision.
Exactly. Watch what happens to the confidence when you do the statistics correctly.
Okay, I am looking at the section on statistical corrections now in the source material. This is where the whole facade just completely crumbles.
It truly does. When you run that naive OLS regression, treating all those recycled dots as independent trials, you generate what is called a t-statistic. In this specific case, the t-statistic is negative 25.9.
Okay, pause. For those of us who haven't sat in a university statistics lecture in a decade or more, give us some context here. Just how big is a t-statistic of 25.9?
It is astronomical. Like, in statistics, a t-statistic measures how many standard deviations your result is away from zero meaning, away from there being no relationship at all. Usually, a t-statistic of roughly 2 or 2.5 is enough to declare a finding statistically significant.
Wow, so 2 is good, but 25.9.
A t-statistic of 25.9 essentially breaks the scale. It tells the computer that the probability of this relationship happening by random chance is virtually zero. It tells you that the valuation of the market predicting the next 10 years is an unbreakable fundamental law of physics.
And if you don't know about the overlap problem, you just look at that 25.9, you publish your paper, and you go on CNBC to tell everyone you've solved investing forever.
Yep. But econometricians, the people who actually study the math of economics, they've known about this overlap problem for decades, so they have built specialized tools to fix it.
Okay, tools to fix the fake confidence.
Right. They built math that essentially penalizes the statistical confidence when it detects that data is being recycled.
I see 3 methods mentioned in the data: Noe West, Hansen-Hodrick, and block bootstrapping. Give me the non-jargon explanation of how these work, because I am not a math guy.
I'll try. Let's use Noe West first. Imagine you are standing in a massive canyon and you shout a word. You hear the echo bounce back to you 100 times. A naive computer would count 101 distinct voices.
Right.
But Noe West is an algorithm that listens to the audio, recognizes the frequency of the echo, and mathematically dampens the volume of the repetitions until it estimates the true number of original voices.
Oh, I love that. So Noe West basically filters out the echoes. What about block bootstrapping? That sounds intense.
Block bootstrapping is even more intuitive, actually. Since we are looking at 10-year periods, the computer chops the historical data up into solid 10-year blocks. Then it puts those blocks into a hat, draws them out randomly to create thousands of alternate simulated histories, and tests how strong the relationship actually is across those random draws.
So it flat out refuses to let the overlapping months artificially smooth the line. So what happens when we unleash these grown-up statistical tools on our incredibly viral, overconfident KP chart? Let me guess, it doesn't stay at 25.9.
The confidence collapses. Under the Newey West correction, that massive, arrogant t-statistic of 25.9 drops to 9.6.
I mean, that is a huge haircut, more than half.
It gets much worse.
Yeah.
If you use the Hansen-Hodrick correction, which is specifically designed for overlapping horizons, the t-statistic drops to 5.1.
Yes.
And if you use 10-year block bootstrapping, it plummets all the way down to 3.2.
Wait, it goes from 25.9 to 3.2. That's insane.
It is a factor of 5 to 8 reduction in statistical confidence, depending on which rigorous method you actually choose to use.
Yeah.
And the most damning part is what this math reveals about the effective sample size.
Tell me.
When you apply the Hansen-Hodrick correction, the math spits out the truth. Your effective sample size isn't 1,593 dots, it is roughly 63. And under block bootstrapping, the effective sample size is roughly 24.
Wow. Let that sink in for a second. The chart shows you this massive, intimidating Roman legion of data points marching in a perfect line. But when you strip away the camouflage, the actual independent fighting force is just 24 guys wandering around a field.
An army of clones rendered down to a handful of actual soldiers.
Okay, this brings us to a really practical question. If the 1,500 dots are mostly clones, what happens if we just delete them? Like, what if we don't rely on complex math to penalize the echoes, but we just manually remove the pseudo-replication entirely?
You mean only plotting the distinct blocks?
Yeah, what if we only plot the true non-overlapping decades?
Here's the same data, but without the recycling.
I am looking at the visual representation of this in the research notes, and wow, this is a visual gut punch. It is honestly shocking how different it looks.
Describe the contrast for the listener. Walk them through the visual.
So imagine the chart. In the background, printed in this faint, ghostly, washed-out gray color, is the original viral chart. The big cloud of 1,593 dots. It still looks dense. It still looks convincing. But then, overlaid right on top of that gray cloud are bright, bold red dots. And there are only 14 of them.
Yeah. Those 14 red dots are the non-overlapping 10-year episodes. They are the actual, unvarnished, independent evidence you have.
And they are spaced out so widely, the beautiful, dense pattern is completely shattered. I mean, to be fair, there's still a very loose, general downward slope, like the red dots on the left side of the chart are generally higher than the red dots on the right side. But it is incredibly noisy.
Very noisy.
It looks absolutely nothing like a deterministic law of physics. It looks like a handful of isolated historical accidents scattered randomly across a page.
Because that is exactly what it is. When you look at the dense gray cloud, your human brain, which is an aggressive pattern recognition machine, is tricked into thinking the relationship is incredibly tight and reliable.
We want to see patterns everywhere.
Exactly. When you look at just the 14 red dots, your brain correctly registers that there is a massive amount of empty space and uncertainty here.
But wait, a logistical question just occurred to me. How do we even choose which 14 red dots to plot? I mean, if we are grabbing non-overlapping 10-year chunks, do we start the clock in January 1880, or do we start in June 1883, or November 1888? Who actually decides where the first dot goes?
That is a brilliant question, and it brings us right to the section of the research on sampling frequency and offsets. You have hit on a fundamental fragility of this data. Because we only have about 14 non-overlapping decades in the entire 140-year history of the U.S. stock market, the specific visual you get and the specific regression slope you calculate depends heavily on exactly which calendar month you arbitrarily decide to start counting from.
Okay, we call that starting point the offset, right?
Yes. If you use offset 1, you are starting your decade blocks in January of the first year of data. But what if you use offset 30?
Offset 30 would mean shifting by 30 months.
Exactly. That means you are shifting your starting point forward by 30 months, beginning your decades in July, 2.5 years later, and then taking strict 10-year jumps from there. The research provides 4 different, completely valid, non-overlapping scatter plots based on 4 different arbitrary offsets.
And they tell totally different stories.
Entirely different. In offset 1, the slope looks quite steep, and the dots actually look somewhat clustered around the line. It might make you think the relationship is decent, but look at offset 90.
Let me look. Oh, wow.
The slope is suddenly much shallower, and the dots are scattered wildly across the axis. Each offset, each arbitrary starting month, spins a subtly different narrative about the historical relationship between valuations and returns.
Okay, I have to play devil's advocate here. I'm going to push back again. Even if the exact angle of the line wiggles around depending on which random starting month we pick, Surely the general relationship holds up over the last century, right?
You'd hope so.
I mean, structurally, logically, buying into expensive markets has to lead to lower returns as a general rule over time, doesn't it?
You would think so. It totally appeals to our common sense. But the empirical research says otherwise. The relationship is actually highly unstable depending on which specific historical era you happen to be living through. Let's examine the period and rolling window instability data.
Let's unpack this. What happens when we stop looking at 140 years all at once and start slicing history up into smaller eras, say 20-year chunks?
The supposedly strong relationship that the viral chart implies actually waxes and wanes dramatically. The research looks at rolling 20-year windows. This means we take a 20-year chunk of history, say 1900 to 1920, we calculate the slope of the valuation to return relationship just for those 2 decades, and then we roll that window forward 1 year at a time.
Like 1901 to 1921, 1902 to 1922.
And so on, exactly.
And as I look at the graph of those slope coefficients over time, the line is going all over the place. It looks like an EKG of a patient having a heart attack.
Exactly. In some eras, the fit is incredibly strong. The line slopes down beautifully, and valuations seem highly predictive of what the market will do next. But in other eras, the relationship completely vanishes. The slope flattens out to 0, and at a few points in history, the slope actually reverses.
Reverses. You mean higher starting valuations actually preceded higher returns?
Yes. Positive slopes. It means if you were an investor living, working, and investing your savings through those specific decades, the so-called law of the KPE ratio would have looked like absolute empirical nonsense to you. It would have cost you money.
That is wild. It completely shatters the idea that this is an immutable law of markets.
And this instability leads us to one of the most fascinating and destructive diagnostic tests in the entire research note, the Leave One Decade Out test. This falls under the category of influence diagnostics.
Influence diagnostics. I love this concept. It is essentially asking the data, who is the loudest person in the room? Which specific dots are doing all the heavy lifting for this trend line?
Precisely. In statistics, not all data points are created equal. Some data points sit so far outside the normal cluster that they exert massive gravitational pull on the regression line. We measure this using a metric called Cook's distance.
So they act like a magnet.
Yeah, they act like a heavy anchor. If you remove them, the entire angle of the line violently shifts. And it turns out the entire apparent fit of the viral keep chart is load-bearing. It rests almost entirely on just 2 extreme historical events.
2 events out of 140 years of history. Let me guess the first one. The Great Depression.
The Great Depression is a massive anchor, yes. When the market peaked and crashed in 1929, valuations were incredibly high, and the subsequent 10-year returns through the 1930s were abysmal.
That makes sense.
That creates a huge, heavy anchor point on the far bottom right of the scatterplot. It drags the right side of the line down. But there is another episode that is even more influential in the modern data, and it is an episode that most people listening to this deep dive lived through.
The dot-com bubble. It has to be.
The dot-com bubble of the late 1990s and early 2000s. The research isolates the outsized, almost tyrannical influence of this single era.
So what happens if we run this dot-com test? Let's say we decide to just exclude the market observations starting between 1996 and roughly 2004. We just take that one singular boom and bust cycle out of the 140-year history. We pretend the pets.com era never happened.
The entire statistical narrative fractures. Let's look at the R-squared.
Give us a quick refresher on R-squared, just to be safe.
Sure. R-squared is a simple measure of how much of the future outcome is explained by your current data. It runs from 0 to 1. An R-squared of 1.0 means perfect prediction. An R-squared of 0 means the data tells you absolutely nothing.
Got it.
The viral chart, with all its overlapping data and pseudo-replication, boasts an R-squared of 0.30. It claims it can explain 30% of the variance in the stock market's next decade.
Which, honestly, in the chaotic world of finance, 30% is considered a massive edge.
All right, it's huge. Now let's start peeling back the layers of deception. First, let's strip out the overlapping data and look only at the honest, non-overlapping episodes. The R-squared drops slightly from 0.30 to 0.28.
Okay, 2.28? Still somewhat respectable, I guess.
But now let's remove the dot-com era from those non-overlapping episodes. We isolate the influence. We drop that 1 decade, leaving us with just 13 independent dots covering 130 years of history.
And what is the R-squared now? Let me brace myself.
It plummets to 0.14.
Wow. It gets cut entirely in half just by removing the late 90s.
Yes. The honest answer, when you remove both the pseudo-replication of the overlap ID, you remove the single most mathematically manipulative historical boom-bust episode, is an R-squared of 0.14 based on a pathetic 13 observations.
That is absolutely devastating. An R-squared of 0.14 from 13 dots is, I mean, look, it is not zero. We aren't saying valuations are completely fundamentally irrelevant, but 0.14 is miles away from the tight, deterministic, buy cheap, earn more law of nature that the viral chart promises. It's a weak signal drowning in noise.
It is the difference between a minor, noisy statistical tendency and a hard, unbreakable rule of finance. The dot-com era does an enormous amount of heavy lifting in driving the visual pattern of the viral chart.
I can see that.
Think about the history. When the CPE ratio reached a breathtaking 43 in the year 2000, the subsequent decade, which included the 2008 financial crisis, was terrible. Then, when CP dropped to the low teens in 2009, the subsequent decade was the longest bull market in history.
So that single boom and bust cycle creates a massive visual cluster at the extremes that anchors the whole line.
Exactly. Anyone who looks at the post-2000 data and says, look how perfectly the KPE ratio predicts returns, is essentially drawing a regression line through exactly two major data points and calling it a law of nature.
It is staggering when you put it like that. 2 data points. And here is where it gets really interesting. It is not just the time periods that are being heavily cherry-picked to make this chart look good. It is also the specific metric they use on the x-axis, isn't it? The viral chart always, exclusively, uses the Shiller KP ratio.
Always. But the analysts and influencers sharing the chart often use it as a proxy for the entire concept of valuation. They imply that any measure of a market being expensive will give you this beautiful, predictive downward slope.
So what happens if we move the goalposts? What if we don't use Robert Shiller's Nobel-winning formula? What if we use a different, equally valid valuation metric?
The research tackles this directly, and the results vary wildly. As we just established, the KPE ratio gives you an in-sample R-squared of 4.30 on the overlapping data. But what if you use the standard trailing price-to-earnings ratio?
No 10-year smoothing, just the last 12 months of earnings.
Right. This is a very standard, widely cited metric on Wall Street.
And what does the R-squared drop to?
It collapses to 0.05.
5%. That is virtually no relationship at all. It is statistical noise.
What if you use the dividend yield of the market as your valuation metric? This was the gold standard for a century. The R-squared is 0.06.
So let me get this straight. Out of all the possible ways to measure if the stock market is fundamentally cheap or expensive, the viral chart specifically deliberately selects one metric, the cyclically adjusted 10-year smooth earnings, that happens to produce the prettiest visual cloud.
Exactly.
If they used trailing PE, the cloud would look like a shotgun blast and nobody would retweet it.
Yep. It is a textbook case of metric selection bias. And the cherry picking doesn't stop there. It also applies to the time horizon.
Right. I want to bring this up. I was looking at the horizon heat map in the source notes. It seems like the longer you stretch the forecast horizon, from guessing the 1-year return to the 3-year return to 10 years to 15 years, the better the R-squared gets.
Virtually, yes.
The fit looks tighter and tighter the further out you go. Doesn't that prove the old adage that valuations matter more over the long term? Doesn't that redeem the chart?
It is an incredibly seductive thought. It perfectly matches the ethos of long-term investing. But the research proves it is largely a mechanical illusion. Let's think logically about why the math improves. As you increase the time horizon from 1 year to 15 years, what else are you massively increasing?
Oh, the overlap.
Well, you're done.
The recycling.
Exactly. A 1-year forward return uses 12 months of data. A 15-year forward return uses 180 months of data. If you are plotting monthly observations on your scatterplot, the 15-year chart has vastly, exponentially more overlap than the 1-year chart.
You're artificially inflating the apparent fit by recycling the data more intensely. The echoes in the canyon are getting louder and bouncing more time.
Precisely. And concurrently, you are shrinking your real sample size. You are reducing the number of genuinely independent episodes you have to work with. In 140 years of history, you have 14 non-overlapping decades. But if you stretch the horizon to 15 years, you only have about 9 non-overlapping periods in the entire history of modern capitalism.
So the beautiful tight fit at the 10 or 15-year horizon isn't revealing a deeper fundamental truth about long-term investing. It is partially just the statistical pathology getting worse. The overlap is artificially smoothing out the noise of reality.
It is the ultimate mirage. Now let me show you what the chart hides.
Let's do it. We are moving into Act 3 of our deep dive here, the uncertainty. And this is where the rubber meets the road for anyone actually trying to use this chart to manage their retirement money.
So the viral chart gives you a single absolute regression line. It is what statisticians call a point forecast. It implicitly tells the viewer, if the CP ratio is exactly 30 today, your expected return over the next decade is exactly 4% per year.
Right. It feels like a guarantee. It feels actionable.
But the research replaces that single arrogant line with an honest prediction interval. This is a visual representation of uncertainty. Instead of a line, it shows a dark shaded band representing the 50% prediction interval, where half of the outcomes fell, and a lighter shaded band representing the 90% prediction interval.
And these bands, they are massive. They take up the whole page.
They are enormous at any given level of valuation, whether the market is dirt cheap or incredibly expensive. The 90% prediction interval spans a vertical range of 10 or more percentage points of annualized return.
Okay, let's go back to my weather app analogy from earlier, because it just really clarifies it. The viral chart is like a weather app that looks at historical climate data and promises you, with absolute mathematical certainty, that on exactly this day, 10 years from now, it will be 72 degrees.
And if you believe the app, you would plan an outdoor wedding, you wouldn't rent a tent, you would bet your whole life on that 72 degrees.
Right. But the honest prediction interval chart is the meteorologist coming on TV and saying, look, based on the historical data, the average is 72. But honestly, the 90% prediction interval means it will probably be somewhere between 40 degrees and 100 degrees.
Which is a vastly different, far less usable statement. It means you still have to pack a winter coat, a bathing suit, and an umbrella. It means the average is mathematically true, but practically useless for your specific day.
Yeah, totally useless.
Let's look at the distribution of outcomes by quintile to really drive this home. The researchers used Violin plots to illustrate this.
Let's explain what a Violin plot is for the listener, because it is such a great visual tool to understand chaotic data. It is not just a rigid box. It shows the actual shape of the historical outcome.
Right, the bulges out.
It gets fat where most of the historical returns happen, and it tapers off and gets skinny at the extreme tails, the rare events.
Right. The researchers take all the historical months of the stock market, and they divide them into 5 buckets. Quintiles based purely on how expensive the market was that month. Quintile 1 is the cheapest 20% of history. Blood in the streets. Quintile 5 is the most expensive 20% of history. Euphoria.
Got it.
Then they look at the subsequent 10-year returns for each of those buckets and draw a Violin plot for each.
The viral chart makes you think that these buckets are totally separated. It implies that if you buy in quintile 5, the expensive bucket, you are doomed to terrible returns. And if you buy in quintile 1, the cheap bucket, you are guaranteed to get rich.
But the Violin plots show that the reality is incredibly messy. The outcomes vary enormously within every single bucket. Yes, it is true that the average return in the cheap bucket is higher than the average return in the expensive bucket. The median shifts down. But the ranges massively, overwhelmingly overlap.
The fat parts of the violins overlap.
Exactly. The best outcomes in the most expensive market bucket are significantly better than the worst outcomes in the cheapest market bucket.
Let me make sure I'm hearing this right. You are saying that even if I perfectly identify that the market is in the top 20% of historical expensiveness, a screaming red siren on the viral chart, I could invest my money and still end up with a phenomenal double-digit 10-year return.
Yes, you absolutely could.
And conversely, I could bravely buy when blood is in the streets, when the market is dirt cheap, and I could still end up with a decade of flat or negative returns.
Yes, because the conditional distribution of returns is incredibly wide. History is full of cheap markets that stayed cheap and went nowhere, and expensive markets that got even more expensive and rallied for another decade. The viral chart hides this dispersion entirely. It collapses all that beautiful, messy, chaotic reality into a single, sterile line.
Okay, but let's say I am a stubborn investor. I am listening to this deep dive, I see all this uncertainty, and I say, you know what? I don't care about the wide bands. I don't care about the overlap. I just want to play the odds. The average is lower when it is expensive, so I am going to build a trading strategy around this chart. I am going to sell when it is high. What actually happens to that investor?
That investor falls face first into the out-of-sample trap.
Explain the difference between in-sample and out-of-sample testing, because this is the ultimate trial by fire for any financial theory.
In-sample fit tells you how well a mathematical model explains the past. It is hindsight. You give the computer all the data from 1880 to 2024 at once and ask it to draw the line that fits best. The computer already knows the answers to the test.
It knows the Great Depression happened in '29. It knows the dot-com crash happened in 2000. It can cheat.
Right, it perfectly fits the curve to anomalies it already knows about. Out-of-sample testing, on the other hand, asks a completely different, much harder question. If I was an investor in the past, and I only knew the data up to that specific day, could I use this model to accurately forecast tomorrow?
Like walking blindly into the future month by month, only using the data that was available at the time.
Exactly. We start the test in, say, 1950. We estimate the CP model using only data up to 1950. We make a forecast. Then we step forward to 1951, update the model, and forecast again. When you run this out-of-sample test with the CP ratio, it routinely fails to significantly beat a naive benchmark.
What is the naive benchmark? What is it losing to?
The benchmark is just guessing the historical average return of the stock market up to that point. Right. Over long periods out of sample, the complex, sophisticated CP valuation model is often no better and sometimes mathematically worse than just assuming the market will deliver its historical average.
The predictive power just completely vanishes.
It vanishes when you remove the benefit of hindsight.
Wow. Okay, let's make this even more visceral. Let's talk about actual money. Let's put a hypothetical investor to the test. If I use this viral chart to actively manage my retirement money, what would actually happen?
The research note tests exactly this scenario. They design a naive timing rule perfectly inspired by the logic of the viral chart. It goes like this. Look at the historical median of the CP ratio. If the current KP ratio is above that median, meaning the market is expensive, you get out. You sell your stocks, you hold cash, and you earn a safe 3% interest rate.
It sounds totally reasonable. It is the exact logical behavior the viral chart is trying to encourage. Sell when expensive, protect your capital, buy back in when it is cheap.
Right. And if the CP ratio falls below the median, you buy the S&P 500. So what is a result of this perfectly logical strategy over history?
I'm guessing it doesn't beat the market.
It is a devastating failure. The KP rule wildly, persistently underperforms a simple buy and hold strategy where you just stay invested the whole time.
But how? If the market is expensive and you dodge the crash, shouldn't you win?
Think about the actual mechanics of the strategy in real time. The market reaches the median valuation. You look at the chart, you declare the market expensive, and you sell. You sit in cash, earning 3%, waiting for the inevitable crash so you can buy back in at a discount. But markets are not physics.
Right.
They can stay expensive for a very, very long time while continuing to go up.
So you are just sitting in cash, earning your little 3% yield, while the stock market is ripping higher by 10%, 15%, 20% a year. You are watching your neighbors get rich.
Right. And the research maps out exactly how long you have to sit in cash waiting for the valuation to finally come back down to the median so you can buy back in.
Yeah.
The median waiting time is 1.3 years. That is annoying, but survivable. But it can be much, much longer. The maximum run above the median in the historical sample was an excruciating 19.9 years.
I need to make sure I am grasping the absolute horror of this scenario.
Yeah.
19.9 years. Basically 2 entire decades of your investing life.
Yeah.
Let's put dates on this. Imagine retiring in the early 90s.
Okay, poor guy.
You see the KP chart. You sell your portfolio because the market crossed the historic average and is now expensive. And then you sit in cash for 20 years. You miss the entire 90s tech boom. You wait through the crashes, but the market never gets cheap enough to signal a buy. You spend 20 years watching everyone else compound their wealth, waiting for a valuation drop that takes 2 decades to arrive.
And here is the truly tragic part. By the time the valuation finally drops back to the median after 20 years, the absolute price of the stock market is likely much, much higher than where you originally sold it, even after a crash.
Oh, man, of course.
The earnings grew so much over 20 years that the market became cheap again at a fundamentally higher price level. You completely missed out on 2 decades of compounding capital.
It's like trying to catch a falling knife in the dark based on a weather forecast from last week. The bottom line is that even if you believe there is a faint, long-term directional signal hidden in that scatterplot, translating that signal into a profitable real-world investment strategy is infinitely harder than the chart suggests.
So much harder.
The chart does not come with a warning label saying, if you act on this, you will probably underperform and ruin your retirement.
Which brings us perfectly to another massive logical fallacy that promoters of this chart often fall into. It is a psychological trap as much as a statistical one. We call it the base rate inversion.
The base rate inversion. This is a statistical trap that even incredibly smart, heavily compensated institutional investors fall into. Outline it for us.
People who share the viral chart online or in research decks often state, as a matter of empirical fact, that high valuations predict market crashes. They use the chart as a fear mechanism, and they will frequently point to a statistic that sounds terrifying, something like 77% of major market crashes happen when the CPE ratio is highly elevated.
Okay, I have heard that exact stat quoted on financial television, and it sounds horrifying. If 77% of crashes happen when valuations are high, and I know valuations are high right now, my brain immediately tells me I need to sell everything immediately. The crash is imminent?
But that panic is based on a fundamental misunderstanding of conditional probability. It is confusing the probability of A given B with the probability of B given A.
This is pure Bayes' theorem territory. Let's break it down simply, because the human brain is notoriously bad at Bayes' theorem.
It is. Let's use an analogy outside of finance to make it clear. Think about professional basketball players. If you look at all the players currently in the NBA, probably 95% of them are extremely tall, let's say over 6'6".
Right. That is a very safe assumption.
So the probability of being tall, given that you are already in the NBA, is 95%. But what is the probability that you are in the NBA, given that you are tall?
Oh, almost zero. There are millions of tall people walking around the world right now who are terrible at basketball, working in accounting, or teaching school. Just because you're tall doesn't mean you are going to the NBA.
Exactly. Assuming that tall equals MBA is a base rate inversion, you forgot to look at the massive base rate of tall people who aren't playing basketball. Now apply that exact same logic to the stock market. It is statistically true that roughly 77% of historical market crashes happen when the market is highly valued.
Okay.
But that is largely because the U.S. stock market spends a massive amount of its historical time, its base rate, in a state of high valuation.
Just like there are lots of tall people in the world, high valuation is the normal state of a growing economy.
Right. So the question an investor actually needs to ask is not, were valuations high before past crashes? The question you must ask to manage your money is, if valuations are high today, what is the mathematical probability of a crash happening soon?
And what is the actual math on that? When the researchers ran the numbers, what did they find?
If you are currently in the most expensive quintile of historical valuations, the absolute top 20% of the KP ratio, the probability of a 20% market drawdown happening within the next 24 months is only about 20%.
Wait, I need to make sure I heard that correctly. If the market is screamingly expensive, hitting historic highs 4 out of 5 times, it does not crash in the next 2 years.
Correct. 80% of the time, that expensive market does not experience a 20% crash in the next 24 months. High valuations are often a necessary condition for a massive crash, but they are an absolutely insufficient condition for predicting one. They do not predict the timing.
That is wild.
If you sell your portfolio just because the market is in the expensive quintile, you are making a bet on a 20% probability event. You are actively betting against an 80% probability that the market will just keep chugging along, paying dividends, and hitting new highs.
It completely flips the script. The viral chart makes you think a crash is a deterministic certainty when valuations are high. The base rate math proves that a crash is actually a vast minority outcome. You're betting on the underdog.
And this base rate blindness is exactly why it is so concerning that major respected institutional players continuously propagate this chart without providing the context. They feed the panic.
Yeah, let's talk about the institutional complicity here. The research notes we are reviewing specifically call out several prominent offenders. This isn't just an anonymous Reddit phenomenon or some day trader on X.
No, it is ubiquitous at the highest levels of high finance. For example, the J.P. Morgan Asset Management Guide to the Markets. This is a cornerstone document. It is used by thousands and thousands of financial advisors to explain the world to retail clients.
Right, everyone reads it.
And they routinely include a scatter plot of forward PE against subsequent returns using monthly overlapping data, complete with a beautifully calculated, highly confident R-squared figure.
And what is the implicit message JP Morgan is sending to those thousands of advisors when they publish that?
The implicit message is clear. High forward PE definitively means low future returns, and here is the ironclad mathematical proof. Look at the tight cluster of dots. But they don't mention the overlap problem in the footnotes.
They just leave it out.
They don't report that the effective sample size is closer to 14 than 1,500. When an institution with trillions of dollars under management distributes a chart like this, it gives the statistical illusion an aura of unassailable, unquestionable authority.
Who else? The notes mention Torsten Slok from Apollo Global Management.
Yes. Corson Slok is a highly respected economist, but he has shared a version of this exact chart sourced from Bloomberg data to argue publicly that investors should expect near zero returns from the S&P 500 over the coming decade because valuations are high. He presents the regression line as a literal point forecast.
Basically saying, just read off the line says zero, expect zero.
Exactly. But as we have discussed at length today, saying expect zero, while completely hiding a 90% prediction interval that ranges from -5% to +8% annualized, is not honest communication. It is taking a highly uncertain conditional mean estimate and presenting it to the public as a certainty. And again, he doesn't mention that the historical fit he is relying on to make this bold prediction is artificially inflated by overlapping horizons.
It's the fake X-ray again. It is the doctor pointing at a smudge on the film, calling it a tumor, and scheduling surgery, without realizing the smudge is just a thumbprint on the lens. And the notes also mention research affiliates, specifically Rob Arnott's team. They published a piece rigorously defending the predictive power of the CAPE ratio, but they did it across international markets.
Right. Their argument is basically, look, we know the U.S. data is limited, but we plotted this exact same scatter chart for 12 different developed international markets, and guess what? They all show the exact same downward slope, so the relationship must be robust.
Let me guess the fatal flaw in that defense. They used overlapping monthly data for all 12 countries, didn't they?
They did, showing that 12 different countries all exhibit the exact same statistical pathology does not constitute 12 independent, robust tests of the economic theory. It just means you took the same overlapping math error and you replicated it 12 times in a row across different borders.
Oh, no. That's rough.
As the research notes conclude, the strongest critique of the KE ratio isn't that valuation is totally useless. It is that the overlapping scatter plot is a visually dishonest, manipulative way to present the evidence.
Which perfectly brings us to Act 4 of our deep dive, the replacement. If the viral chart we see every day is visually abusive and statistically flawed, how should we be looking at this data? Here is what an honest version looks like.
We are looking at the final comparison. This is the side-by-side. I want you, the listener, wherever you are, to build this image clearly in your mind.
Imagine two charts sitting side by side on your screen.
On the left is the viral chart. It is what you see on social media, what you see in the JP Morgan deck, 1,593 dense, tightly clustered blue dots, a sharp, unforgiving red regression line slicing downward right through the middle. Fake precision, zero indication of uncertainty. It screams at you, I am a law of finance, obey me.
And on the right side of the screen,
On the right is the mathematically honest chart. It contains exactly the same underlying historical data. It covers the same 140 years, but it only plots the genuinely independent, non-overlapping 10-year episodes. It removes the echoes.
so instead of a dense cloud, it is just 14 dots.
Just 14 lone dots scattered across the grid. The red regression line is still there, showing a general loose downward trend because cheaper is generally better than expensive. But around that fragile line is a massive, incredibly wide shaded blue fan. That is the prediction interval. It shows massive dispersion. It virally communicates deep, unavoidable uncertainty.
When you look at the chart on the left, you want to panic, liquidate your 401k, and try to time the market to save yourself. When you look at the honest chart on the right, you shrug. You realize the future is completely unknowable, the dots are scattered everywhere, and you probably just need to stay invested in a diversified portfolio because literally anything could happen over the next 10 years.
Exactly. The behavioral impact of the honest chart is completely different, and that takeaway is absolutely crucial. The bottom line of all this research is not that valuations are completely irrelevant. We are not saying price doesn't matter. Valuations might contain some long-run information about expected returns. It is logically sound that paying astronomically higher prices for a stream of earnings might lower your expected yield over a long time horizon.
Right.
But the viral scatter plot is a fundamentally dishonest, statistically sloppy, visually abusive way to present that information. It creates a completely false impression of the strength, the precision, and the reliability of the evidence. The question is not whether valuations matter. The question is whether this chart is a serious way to make that argument. It is not.
So as we wrap up this deep dive, I want to leave you with a thought that goes beyond just PE ratios, standard errors, and scatter plots. We have just spent the last hour meticulously dismantling one of the most widely accepted, institutionally circulated dogmatic laws of modern finance. We have seen how a chart that dictates billions of dollars of asset allocation is actually a statistical mirage. It is built on recycled data, pseudo-replication, and the massive, outsized anchor of just a couple of historical outliers like the dot-com bubble.
It's pretty humbling, honestly.
Yeah, if this chart, which looks so perfect, so mathematically scientific, so undeniable when you first glance at it, is actually just a parlor trick of overlapping horizons, what other foundational truths of investing are we blindly accepting?
That's a great question.
Does our desperate innate psychological need for certainty in the chaotic, terrifying, unpredictable world of financial markets make us inherently vulnerable to beautiful, mathematically flawed charts? Do we embrace the fake X-ray? Do we listen to the overconfident doctor just because we are absolutely terrified of navigating the muddy waters of reality?
That is the real danger, isn't it? We want the precision so badly, we crave the certainty so much, that we completely stop asking how the picture was taken in the first place.
Let that simmer. Thank you for joining us on this deep dive. Keep questioning the data, always look for the overlap, and remember that when someone offers you perfect clarity in a complex system, they're almost certainly hiding the muddy waters. See you next time.